Now we go into the it could go either way crowd, which is, TLT, long dated bonds. We have a pretty clear three-wave pattern on a large scale, A, B, C. The C wave to me is unfolding in 5 waves, right? So obviously it's 1, 2, we have a third wave here, fourth wave here, and fifth wave here. So we have enough waves in place to say that this is the low. However, the problem I have is that this is very overlapping and wavy. It doesn't look like, it looks like a corrective wave. Also, you see how shallow that second wave was? This makes more sense. It'd be a fourth wave. It's a little bit longer in time and deeper. And we really are not finding many buyers above the 121, 123 level. If we break above there, then to me, the low is in, and we can just, just relax a little bit with rates, because rates will probably start a multi-month downtrend, which will also help equities, especially tech. However, until that we break above here, to me, it seems like it wants to take one more low. Now, you think about what would cause the macro picture for bonds to get sold again, it would have to be something around inflation. And as we're seeing with the market right now, a lot of inflation, the data we have right now is being priced in, right? The Fed is getting closer and closer to less aggressive and probably closer to a top in their rate hike cycle, which is what the US dollar is picking up on, equities are picking up on. So it'd have to be some new shock to the inflation situation that would cause everyone to start selling bonds again into this final fifth wave. And there's a lot, what would cause that for oil prices to go up. It would cause something like that when we have a war going on, for example. There's now threats of Taiwan and China invasion into Taiwan. If something like that happens, it would make sense that this would be your fifth wave move down. As inflation goes up with oil prices going up, bonds would definitely get sold, rates would go up, and that would also hit equities. So when it comes to these bigger kind of bear market scenarios where, we have an A and then a B and then the C wave down, that C wave is usually an unforeseen shock, something that the market has yet to see or price in. It doesn't have to happen. If you go back to other bear markets like 1962, the early 90s, the early 80s, we just had a move like this, like a 20 to 30% move, and then we just took off, right? So it doesn't have to happen this way. I'm just looking at what are bonds telling me right now? It looks like it wants to take one more low down. So what would cause that? And this also lines up with crude oil. Every way I count this, this looks like an incomplete 5-wave pattern up. 1, 2, 3, very clear corrective pattern. I hope we were really tracking this up here and warning everybody that if you're into energy and oil, this is a B wave, and we got a C wave targeting the low 90s, mid 80s, which is exactly what we have. We're starting to get signs of selling exhaustion, and we have a full corrective pattern. Can we extend lower? Of course we can. But this looks incomplete to me. It looks like, crude wants to take another shot up into the 128, 136 region. So once again, I ask, what's this telling me? I mean, this count could be wrong, and I hope it is. Maybe we just consolidate sideways for a very long time. That would be fine with me.